You found the perfect rental. You found a DSCR loan that doesn't even look at your income. You are ready to go. And then the lender says, no. Here's the part nobody tells you about DSCR loans. Just because they skip your pay stubs does not mean there are no requirements. There are real boxes you have to check. And missing just one of them is how investors get denied at the finish line. So today, I'm going to walk you through every single requirement to qualify for a DSCR loan, show you the one that trips up the most people, and hand you a simple checklist so you walk in already approved in your head. Let's get into it. Quick note first, this is education, not financial advice for your situation. And DSCR guidelines vary by lender and change over time. So use this as your roadmap, then confirm the exact numbers with your lender. That's what I'm here for. Let's start with the good news because it's genuinely great. A DSCR loan qualifies on the property, not on you. No tax returns, no W-2s, no pay stubs, no debt-to-income ratio. For self-employed people and investors whose tax returns don't show much, that is a game changer. But that one big advantage makes people think a DSCR loan has no rules at all, and that's the mistake. So let's go through what the lender actually checks, one requirement at a time. Requirement number one, and it's the big one. The property itself has to pass the DSCR test. Remember, DSCR is the rent divided by the full payment, your principal, interest, taxes, and insurance. Most lenders need that number to be at least 1.0, meaning the rent at least covers the payment. Hit 1.2 or higher and you unlock their best rates. And here's where people get denied. They find a property they love, but the rent doesn't cover the payment. The number comes back at 0.9 and the deal dies. This is the single most common reason a DSCR loan falls apart. The good news is it's fixable, and I'll show you exactly how in a minute. Real quick, if this is already saving you from a denial, do me a favor and tap like. It genuinely helps a small channel like this get shown to more investors who need it. Okay, on to the rest. Requirement number two, your credit score. Yes, they skip your income, but they absolutely check your credit. Most DSCR lenders want a minimum score somewhere around 620 to 680. The higher your score, the lower your rate and the more you can borrow. Dip below their floor and you're either denied or pushed into a worse rate with a bigger down payment. Requirement number three, your down payment. Because the lender is taking on more risk, they want you to have real skin in the game. Plan on putting 20 to 25% down on a purchase. On a cash-out refinance, expect to leave even more in, around 25 to 30%. Show up expecting to put 5% down like a first-time home buyer, and you'll be turned away fast. Requirement number four, cash reserves. This one quietly sinks a lot of deals. After you've paid your down payment and your closing costs, the lender wants to see that you still have several months of the full payment sitting in the bank, often 3 to 6 months worth. They want to know that if the property sits empty for a bit, you can still cover the mortgage. Drain every last dollar into the down payment with nothing left over, and you can be denied even with a great property. Requirement number five, the property itself has to qualify. It has to be a non-owner occupied investment property, usually 1 to 4 units, and it has to be in rent-ready condition. The appraiser does double duty here. They confirm the value, and they fill out a rent schedule that tells the lender what it should rent for. That appraiser's rent number is what your whole DSCR calculation is built on, so it matters a lot. Requirement number six, you and your entity. The good news, you can usually close in the name of an LLC, which is one reason investors love these. But the lender still runs a background and credit check on you personally, and they want to see you don't have a very recent bankruptcy or foreclosure. Some programs welcome first-time investors. Others want to see you've owned a rental before to give you their very best terms. And requirement number seven, the loan itself. Most DSCR lenders have a minimum loan amount, often around $75,000 to $100,000. So very cheap properties can actually be hard to finance. And many of these loans carry a prepayment penalty, so you have to be okay with that, or pay a little more up front to buy it down. Okay, that is the wall of requirements. Now here's the comeback, because almost every one of these is something you can fix or plan around. Let's go back to the big one, the DSCR ratio, the deal killer. Say a property's rent doesn't quite cover the payment. You are not stuck. You have three levers. One, put more money down. A bigger down payment shrinks your loan, which shrinks your payment, which raises your DSCR. Two, buy in a stronger rental market where the rent is higher compared to the price. Three, find a lender with a lower DSCR floor. Some will go down to 0.75 or even offer a no-ratio loan in exchange for more money down and a higher rate. For the other requirements, the playbook is just as simple. Credit too low? Pay down a card or two and wait a couple of months. Short on reserves? Build your savings before you shop, not after. Worried about the appraisal rent? Ask your agent for the rent comps before you ever make an offer. Every wall has a door. Let's run a real one, start to finish, so you can see it click. You find a rental priced at $250,000. You put 20% down. That's $50,000. So you're borrowing $200,000. At an example rate of 7.5%, your principal and interest is about $1,400 a month. Add taxes and insurance, roughly $350, and your full payment is about $1,750 a month. Now the key number. The appraiser's rent schedule says it rents for $2,100 a month. So we take the rent, $2,100, divide it by the payment, $1,750, and we get a DSCR of 1.2. That clears 1.0 with room to spare, so you get good pricing. Your credit is a 700, comfortably above their floor. And after closing, you've still got 6 months of payments, about $10,500 sitting in the bank. So run down the checklist: ratio, check; credit, check; down payment, check; reserves, check; property, check. You are approved. Now watch what happens if that exact same property only rented for $1,600. $1,600 divided by $1,750 is 0.91. Below 1.0, denied. But pull the first lever. Put 30% down instead of 20. Now your loan drops to $175,000. Your payment falls to about $1,575. And that same $1,600 rent now gives you a DSCR just over 1.0. The exact same property goes from a no to a yes, just by changing how you structure the deal. That is the power of knowing the requirements before you shop. So let's lock in your checklist. To qualify for a DSCR loan, you need a property whose rent covers the payment, a DSCR of at least 1.0, a credit score generally in the low to mid 600s or better, 20 to 25% down, a few months of payments and reserves, a rent-ready investment property that appraises and rents where it needs to, and a clean enough background, closing in your name or your LLC. Miss one, and you can get denied. Hit all of them, and you walk in with the confidence of someone who already knows the answer is going to be yes. This is education, not personalized advice, so talk to a licensed professional. That's what I'm here for, about your exact deal and which lenders fit your numbers. If this just saved you from a denial or finally made DSCR loans make sense, do me a real favor and hit like and subscribe. This channel is still small, and every like and subscribe tells YouTube to put this in front of more investors trying to build something real. It's free, it takes 1 second, and it's the single biggest thing that keeps these videos coming. I'll see you in the next one.